Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm joined by Zacks stock strategist, Ethan Feller, to discuss how to pick stocks in a sell-off. So this is an interesting time for stock investors or traders because it's been kind of rough 2 months here. We've had a sell-off in September, but then I was told it was supposed to end. We were supposed to resume the rally in October, but that has not happened. And now we're wrapping up October and stocks are still weak and still in this kind of bearish sell-off. So how do you invest or trade in this type of market? I brought Ethan on board here to give us some of his advice. And also he's going to let us know what he sees happening out there, because every week on this podcast, you hear my take on the market and the economy and whatever's going on Wall Street. So it's good to get other people's perspectives. And so, Ethan, welcome to the podcast today.
Yeah, happy to be here. Thanks for inviting me on, Tracy.
Yeah. So what is going on out there? This is a much weaker market than I think most people assumed it would be going into November, but November and December are usually two of the best months of the year. So what do you see happening out there on, the technical side, fundamental side on, with stocks right now?
Yeah, sure. So yeah, I agree. We definitely got some unexpected divergences. We all heard about how the second half of October was supposed to be extremely bullish, and how the third quarter of the year, or the last quarter of the year, is supposed to be a very bullish time of the year. But there's a lot of cross currents coming in at the moment, sort of shaking up the market and, adding some additional uncertainty that sort of wasn't expected. So before I make any stock recommendations or decide what I want to buy or sell, I really want to take a detailed inventory of the current market environment. And I want to best understand where we are today so that I can position myself for a few different future scenarios rather than trying to immediately forecast what I think is going to happen in the future. So where are we today? What's going on? What happened? So we're experiencing the worst sell-off of the year so far, the largest correction in what has so far been a pretty good year for most of the stock market. The S&P 500 is now 10% off of its highs, and NASDAQ is about 12%, and they're still up nicely on the year. However, if you look at the Russell 2000, there's a pretty significant divergence there, and it's actually trading right at its 2022 lows. So the small caps have been hit significantly harder. Now, what's causing the market to sell off? What's happening here? Most recently, we've seen an escalation in this conflict in the Middle East, which has increased geopolitical uncertainty, and we don't know what's going to happen here. Is the U.S. going to get involved? Is it going to continue to escalate? So that's the first thing that really recently has increased uncertainty in the market. But also, extremely important development is the rapid rise in interest rates, especially in the long end of the Treasury curve. And we've seen that the 10-year Treasury note is now trading at 5%, which really shifts the dynamic in the markets, because higher interest rates means it's more expensive to borrow money for companies. And it also makes these fixed income instruments a lot more competitive. And, people might consider, okay, I got this stock, it's got a lot of debt, it's not growing very fast, it's kind of an uncertain time. Maybe I'm going to switch over, I'm going to buy some treasuries, and I'm going to collect my 5% over the next year or 5 years or 10 years and just hold steady for now. So that's a few of the things that's going on right now. And is there anything you want to add, Tracy?
Well, just that, if you're talking about alternatives, why not just go in cash too? Like if I can get 4 or 5% in cash with no risk whatsoever, Why not do that? And so I can kind of see what the dynamics were in the 1970s. By the time Bloomberg or Business Week magazine, as it was known then, put out its now infamous cover about the death of equities. Yeah, if you're getting like 15% on a CD, yeah, I'm not buying any stock with that going on. And we're not even at that. We're only at 5% right now. But even at 5, it's looking pretty attractive.
Now, alternatively, maybe there's too much fear in the market, and some stocks are looking, pretty reasonable at current levels. So, I think it's pretty easy to at any time write a very bearish narrative about why stocks should sell off. But the stock market proves time and time again that it climbs this wall of worry, and it usually just goes higher, especially over the long term. We know it goes higher. But, I think with the dynamic with higher interest rates and sort of, an economy that could, possibly shift to a slowdown, I'm not rushing into growth stocks or anything too speculative. But I think stocks that have sort of long-term economic secular trends, tailwinds pushing them higher, that are trading at reasonable valuations. I think those are I want to be a little bit more defensive and look for stocks where the downside is limited and the long-term upside is pretty good.
So you would say you're not in GameStop right now?
No, not today.
Okay, that's good.
But there's other not even quite that speculative. I like some cybersecurity companies are fast growing and they got really great tailwinds, but they're trading 50 times, 70 times earnings, and it's I want to find something a little bit less speculative than that too.
Okay, so the Palo Alto networks of the world, those are kind of off the list. What about like drug stocks? Some of them are trading in the 40s and 50 times now too, because the weight loss drug kind of craziness. So I would assume those are also off for the same reason, because of
Yes.
valuation
Yes,
issues.
definitely.
Okay. So what would be in what are some areas that you do consider to be, the right valuation side, plus maybe some other opportunity there, but maybe has a defensive edge to it?
Yes, definitely. It's exactly what I'm looking for. So should I get into the first stock?
Sure.
Okay, cool.
So, for those of you who are listening, we are sharing our screens today again on the video podcast, which you can get on Zacks.com/YouTube on our YouTube channel. Okay. That's my little message for today.
So you see my screen? Is it up?
Yes.
So the first stock I'm looking at is Vistra, or Vistra Corp. It's an electric and power utility company, and it is one of the utility stocks that I think, or that is sort of one of the front runners in terms of leading the energy transition to more alternative based energy. They have a really nicely diverse, so it's not only alternative energy sources, they have a nicely diversified set of energy assets. They have natural gas, solar, they also have nuclear and battery energy assets. And it's got very reasonable valuation, and it's got good relative strength, and we'll get into all that right now. So first thing that drew my attention to it was so the utilities sector has really gotten bombed out over this last year, or over the last few months, really, as treasury and fixed income assets have really have gotten a lot higher interest rates and better income for investors. A lot of investors have rotated out of utilities, which have been sort of a haven for more conservative investors that are looking for regular income, because utilities are very steady. They offer nice dividend payments, and they're not going anywhere. But as we said before, now that these treasury securities are offering such nice interest rates, a lot of people got out of utilities. So utilities have not performed well. However, Vistra has performed extremely well. It's had a great year. We can look at this year-to-date chart right here. Vistra was trading at $22 at the beginning of the year and is now at just above $32.58. So it's up 50% year-to-date. So let's take a look actually at the industry chart. So I'm going to go to, we're looking at the
And
electric industry.
why has Vistra outperformed when everybody has fled the others? Is it because of like the nuclear side or just the diversity of their portfolio?
Yeah, so it's probably a few things. It's it's got great sales and earnings growth, most importantly, and and I think also just the energy transition too. I think has played a big factor, and it's also benefiting from the Inflation Reduction Act. It's gotten some nice tax breaks because of its rapidly shifting energy assets. And yeah, it's really drawn in investors much more than the rest of the industry. So here's the industry chart.
And I saw that it did pay a dividend and it's yielding 2.5%.
Yep.
Do they have like a history of raising it, or do you know? I don't know on some of these utilities, or if that's just pretty steady.
I didn't look. I'm not exactly sure. We can take a look at that though. We'll go back right after we check out this chart. But so we can see that utility industry here in green, electric utilities, is down 15% year to date. While IVV, which represents the S&P 500, is up 10% year to date. So that's 25% spread between the industry. And we know that Vistra is up 50% year to date. So it's considerably outperformed the industry and considerably outperforms the broad market. So I like looking for relative strength, and it's further bolstered by its very reasonable forward earnings multiple, and is trading at 9.2 times forward earnings. And this is below the industry average, which is 12.5 times earnings, and it's below its long-term median, which is 13 times earnings.
Well, I know as a value investor, anything under 10 times, is always considered to be pretty cheap.
Sure. So yeah, even after such tremendous stock price appreciation, it's still trading at a very reasonable valuation. And yeah, like Tracy noted, it's got a 2.5% dividend yield. I think we can see dividend history here.
Does it?
And yeah,
tell us? Here we go.
It's got a regular increases in its dividend payment. Annualized dividend growth over the last 5 years is 13.2% annually. So it's a nice.
Yeah, looks like it's pretty consistently raising it a bit. So that's good. That's
10
what
dividend
investors want.
increases over the last 5 years.
Okay. If we get out of utilities, what is another area? I just saw one of the strategists talking about, other defensive areas you could be in on CNBC, and he was talking about the Magnificent Seven. But we all know that that's kind of where you can go as a defensive play. What has worked this year? It's been the Magnificent Seven, or at least most of it. Most of the components in there have had a good year, even if they're off their recent highs. But as the strategist said, he considered it to be a crowded trade, and that eventually it too will roll over. It's not what we want to hear, though, right? Because all of us own this. We own it if we own the triple Qs or the S&P 500, or we might own even the individual positions. So what's your take on the Magnificent Seven? Is there one of them, or is there something in there that is more defensive than one of the others? I'm assuming it's not going to be NVIDIA.
Yeah. Those are really good points. I mean, you're right. They've gone on a huge run this year. Although it's worth noting, they came off such depressed lows in 2022. They really got sold hard. So, but yeah, I agree. There is one that I think is a particular standout. and it's Alphabet. Alphabet, they just reported earnings last week, and the market actually really didn't like it. They beat on both top and bottom line, but they missed their cloud growth estimates by just a couple percent. I think it was 8.6 billion was what they were expecting. I think it came in at 8.4. So it was a slight miss, but cloud still showed 22% annual growth. So there's a few reasons why I prefer Alphabet to the rest of them. One, I think that this sell-off that I just experienced following earnings report is a little bit short-sighted. It's still got a lot of really good, strong growth. Sales just reaccelerated to 11% year-over-year growth, which is now back to double digits. And it's got the lowest relative valuation to the other Magnificent Seven. Its forward PE is 21.8 times. And it also has earnings per share growth forecasts of 15.36% annual growth, which is the second highest besides just Meta.
Now, I do have to say about Alphabet, I own it in my own personal portfolio, but I didn't buy it until about 5 years ago, maybe 5 or 6 years ago. I can't remember exactly, maybe 5. And I kind of threw in the towel on it when I ended up buying it for my own portfolio because over the years, I've followed it as everybody else has, and they kept growing earnings over 10% and sales. The revenue side over 10, in fact, over 20 on the sales side year over year over year. And at some point I was like, well, this has to end. Nobody can keep doing it like this. And they certainly can't even keep doing double digits, as we've now seen with Apple, who's not doing the double digits on the revenue side anymore. But it's had a few years where occasionally it will dip down, but it resumes the double digits on the sales side. And that is just so incredibly hard and impressive with a company that's this big. I mean, it's just, I can't even have more words than that. So that's why I
it's
ended
got
up
a really
buying it
phenomenal
5 years
business
ago.
model.
Yeah, right.
It's hard to beat.
Yeah. And I feel like some aspects of it get overlooked. I know that everybody is all into the cloud and that wasn't as big a growth driver last quarter as people were hoping it was going to be. But then you switch over and look at just what YouTube is doing. YouTube has always been kind of this throwaway within the company. And it wasn't even until just a couple of years ago that they started telling us what YouTube was doing on the revenue side. It was never separated out as a separate entity until just a couple of years ago. And now you can see why, because it's crushing it, especially on the advertising side. So people kind of just overlook Google because it's just in our everyday life so much, either on YouTube or maybe you have an Android phone like I do and you're using Google Pay and maybe you're on a Google app of some kind through their app store and not on Apple. But it's always been impressive, but kind of overlooked, I feel.
Yeah, it's impressive. You can see.
Oh, is this telling us on the revenue on the YouTube?
Yep, this key company
side
metrics
here
tab.
you've pulled up. So what does that show year-to-date estimates on the YouTube there?
Yeah, so it looks like fiscal year 23 estimates are 31.3 billion.
Yeah.
Just YouTube.
Wow.
So
does it give, it does give us the other years. So in 2018, it was parsed out then for 11.1 billion. So in those 5 years since I've owned it, it's basically almost tripled its YouTube revenue, just that alone. Wow. Yeah. So, where's the cloud on there? So the cloud is down a couple slots there. Google Revenue Cloud is at 33 billion. It looks like they're expecting. Is that right?
Mm-hmm.
Or is that millions? That's billions. Billion. Okay, so about equal with the YouTube, but yet everybody's kind of panicking about the cloud and they just overlook the YouTube. So, I've always considered it to be not a value stock per se, but when it gets down where it is trading, I think at 21.8 times, that is on the lower side, although I have seen it go under 20 off and on, especially when the pandemic hit, because its advertising business did get hit. So it was trading at like 17 times or something around that
I think
in
its
that
historical
period.
median over the last 10 years is 26,
Is
26
it?
something.
Okay.
So it's
Okay.
below its median.
Yeah. Yeah. Definitely. So, okay. So someone could hang out in Google or Alphabet
Yeah.
as it's officially
And,
called.
it's just a quick point. A lot of people say, oh, is AI going to be, is this chat GPT going to disrupt Google's search engine business? And I just think they're totally different technologies. And I think Google search, it's got a 95% market share. And I think you're looking too far into the future to think that that's going to get disrupted. So I think, being defensive, I think Google is a pretty fair bet here.
Okay. Here's a question for you. Do you think Google or Alphabet should spin off YouTube?
That is a good question. I mean, it sort of fits right in. I mean, it's like a search engine, right? So
It is. So your answer would be no. You
I
don't
don't
think
think
they
so,
should.
no.
Okay. All right. Leaving the Magnificent Seven, what other area do you feel maybe someone could hang out in, right now?
Yeah, I think oil and gas and energy has some longer term tailwinds that uh, you can rely on near term and over the longer run. And they're also most energy stocks are trading at very fair prices. Um, I quite like the super majors, Chevron or Exxon, and I think Chevron is a little bit more appealing right now. Um, Both just completed some near record breaking acquisitions. Chevron acquired Hess, the oil company that sells the little holiday trucks that I was always getting when I was growing up. And it was a really great strategic acquisition. Hess has the second largest ownership in Guyana, which is a small South American country that is recently discovered huge offshore oil reserves, and so that gave them a 30% stake in the Guyana offshore reserve. So they're well positioned. We see the industry consolidating, and the longer term tailwinds for oil are that there's been pretty significant underinvestment over the last decade or so, and there's been a few factors that cause that. Firstly, the what we were talking before about the energy transition to alternative energy sources has really penalized any kind of investment in oil because, of course, it's not green. So there hasn't really been a lot of build out into oil and gas infrastructure. So it takes a long time to build those assets, and you don't really see too much new investment in them. So there's going to be a long time before any new supply really comes onto the market. Um, Also limiting more investment is during the last capital cycle, like early 2000s to 2011 or so, there was gross overinvestment in oil assets. And a lot of oil companies got killed on the downside when oil fell below $100. So they all kind of have some PTSD from that prior commodity cycle. So just in general, there's an undersupply of new oil. So that'll keep a bid likely under the price of oil for a long time. And this, geopolitical tension abroad in Ukraine and now in the Middle East, is an additional factor that could push oil prices higher, which would increase the profits for these oil companies.
So Is Chevron, I know, is, since it's one of the big oils, it's been paying that dividend for many, many years now. And I believe it is a dividend aristocrat, isn't it? And that means it's been paying and raising its dividend for over 25 years. I did just hear, I thought they said they raised it for the fourth quarter, like 8% again. So the dividend was just recently raised again, but I see it's yielding is that 413 there?
4.13%. Yeah.
Yeah.
That's a nice yield there. And like I said, a very reasonable valuation, 10.4 times forward earnings, with earnings growth forecasts 13.8%. So we got upside and the downside is limited. And you can see the PEG ratio is under 1. So it's
The energy is still hated, but for people looking for somewhere to hang out right now, with that dividend, I think it's a good area to be looking around for all the reasons you just mentioned. I see on that chart it does have a quite a big sell off here. I haven't been paying any attention because I know that energy did well in September, but now it's not doing so well. The WTI has come down off of its recent highs. And then we see quite a nice little sell off here. I wonder if, obviously this is a buying opportunity. If it continues to slide, it's going to get even cheaper while those earnings are on the rise.
Yep. I think people can be quick to look, earnings are down significantly for Chevron this year, but they forget that oil was $130 a year ago. So, and but they got to build up a huge cash position. Now they can buy new assets. So I think they're in a pretty good position going forward.
I've never owned Chevron. I did own Exxon for about 15 years at one point. And for those people who've listened to this podcast a long time, they know that my grandmother owned Exxon for like 45 years until she passed away. And then my great aunt, her sister, also owned it for about 50 years. And she just recently passed away, because they inherited from my great grandfather a few shares. It was literally just like a handful of shares, but neither one sold all of it. And so they were like really long term shareholders. But I owned this smaller energy company for several years, and they just got bought out by Chevron a couple months ago. So it was PDC Energy. And now I own Chevron because they are doing all these deals with shares. And I don't own Hess though, so I'm not going to get any more Chevron. But so this is my first time owning this. We do know that Warren Buffett is big into Chevron, and he bought in a couple of years ago. And I do believe that it was one of the lieutenants who bought in when oil went negative in 2020, because then they started selling that position pretty quickly within a quarter or two, but they didn't sell all of it. And then suddenly Buffett came in with that big check to buy, the billions of dollars worth. And now they still have that considerably large position. I think.
Yeah, I think between Chevron and Occidental, which is where he continues to build a huge position, I think together they now make his largest position. So
Okay. Together, I could see that combined. Well, I'm not sure though. Is that still bigger than Apple? I'm not
I don't
sure.
know. It's good. It's either
It
close,
definitely would be bigger than,
maybe
Bank
second
of
biggest,
America.
but it just shows his positioning. He clearly likes oil assets going forward. And another point I want to make is that as much as we have these policymakers really pushing for this transition and these forecasts for a shift away from oil, a lot of these oil executives say, you know, as much as we want this too, I don't know if it's realistic. So you have that sort of contrarian position where people don't want to own oil, and if you're willing to, you might get a good deal.
Um, on that same topic, since we're bringing up Buffett, I managed to buy Berkshire Hathaway in the insider trader portfolio here at Zacks last July. And the insider trader is a short term portfolio. We're only supposed to own about 1 to 3 months, but I've been known to own them for 6 or more, depending on what's going on with the market conditions. But I can't remember a time that I have stayed in a stock well over a year. And now it's, a year and several more months. And that is with Berkshire Hathaway. And the reason I have stayed in it is because it fits in perfectly with what we've been talking about here all during this podcast, is that it is a defensive play. And last year it was cheaper than what it is now. It's actually gotten quite a bit expensive because it did bust out to new all-time highs here in 2023, but it is off of those highs recently. And so, but it's just not as volatile as many of the other large cap stocks. I feel like a lot of people, you're either in this one or you're not. It's not like traders are trading Berkshire Hathaway. Yes, you have the B shares and the A shares. Nobody's trading the A shares really, but the B shares are a little more affordable for you and I. But let's see what it's trading at, $340 right now for the B shares. So, mom and pops can buy this, but people tend to hold on to the stock. They are believers in Warren Buffett and Charlie Munger. And as long as they're still around and still doing their annual meetings and, still putting out their philosophies of how they invest, then you're going to get a lot of people just kind of hanging out in this stock. Also, the stock, as I said, isn't real cheap here, even though you're like, it's Warren Buffett, I'm buying a value investor, but it's trading at 21 times now. And so I do consider that to be pretty pricey. Now, I am showing the price and consensus chart on the video, and you can see it's a little dicey. The analysts have gotten a little bit pessimistic here, and the estimates have come down a bit, but by 2025, the analysts are looking pretty bullish. And that's probably just because they think we'll be done with the recession by then. Because let's be honest, Berkshire Hathaway is basically the entire economy in that portfolio. And so it's, a question of, every type of industry. And when you have Apple doing well, which is its largest equity holding, then the stock tends to do pretty well. Apple's pulled back a bit here, so the Berkshire stock is pulled back, but it's got the big railroad, which will also do well when we get past a recession, if we're going to have one. And it does still have kind of that manufacturing bent to it, though, with a lot of its businesses. And then it also has, a lot of it has the auto retailers. Nobody really talks about them. He doesn't own them in the equities, but he owns the company and other companies that are in housing. He has the manufactured homes. And so basically they're in everything, and it is going to kind of move along with the rest of the market, but not as dramatically. And so that's why I like to be in Berkshire when you have a lot of volatility or you have sell-offs, because while it has weakened recently, it's not as dramatic as the overall market, or, you're not going to get these big swings normally of, 10% down on a single day in this stock. So I like Berkshire Hathaway a lot. And this is one you could maybe kind of hang out in.
Yeah, I just want to know, you saw in 2022, it had a positive performance, which was one of the most painful bear markets in recent years. And then this year, when we have a strong year, it also performs well. So that's his goal. Do well in the good years and do not so bad in the bad years.
For sure.
Continues to hold true.
Yeah. And the stock kind of reflects Buffett and his philosophy. It's kind of a grinder stock. You're not in it again for the quick gains or, and quick anything. You're kind of just in it and it grinds, and then it, will do its thing. So you do have to have some patience with it always. But again, I feel the people who are buying this stock are more likely to be value investors and are a little bit more on the patient side, or at least they should be. Okay, so other than these kind of like defensive plays, though, I did want to take a look at one of the stocks that has been just really beaten up. I recently did a podcast about how low can some of these stocks go in the sell-off, and it turns out that they can go lower because that podcast is only just a couple of weeks ago, and as this correction has continued, those stocks have gone lower as well. That's why I do encourage people to put some of these on their watch list, or to have like a dollar cost averaging type of strategy for if they go lower, you continue to buy in and buy more shares. But the stock I wanted to talk about is Block. This time I'm going for another one of the fintechs. On that other podcast, I did talk about PayPal. So I'm talking about Block. I did bring up their price to consensus, and this is similar looking to PayPal's. But you know, it's an interesting price and consensus chart because the consensus is higher for every single year, quite dramatically. In fact, if you look at how widespread those lines are across the chart, that means it's, pretty big gains are expected here over the next couple of years, but the shares continue to slide. And I had to take a look, even 5 years now, they're down 48.5% over the 5 year period. And Block, formerly known as Square, along with PayPal, these were two of the big winners during the pandemic. You can even see it on this chart in 2020. Huge rally, and it's given it all back and more. So the question is this somewhere you should be getting into right now on this type of correction? Well, this one and PayPal would be a play on if you think we're kind of getting close to the bottom here on this correction, and just a play on value. So Block is trading at 23 times. It's not as cheap as PayPal, which is around 10 times. But both of those companies are reporting earnings this week. So by the time you listen to this podcast, they probably already have. So I do encourage people to take a look at the detailed earnings estimates. I'm bringing that up right now. So I can even just take a look. What are the analysts expecting going into this? Well, it's not too bad. You can see under the agreement tab there, there's more. Someone is expecting it to be a little bit better in the last 7 days. Then nobody is cutting here. So these fintech, Ethan, what do you think about this area? Because look at this earnings growth here: 2023, 69%, 2024, 36%, but the stock continues to sink.
Yeah, I think it's pretty crazy, and it looks like a pretty good opportunity to me as well. Like you said, it's a little bit higher, 23 times earnings, but earnings per share are forecast to grow 30% annually over the next 3 to 5 years. And I hardly go into a brick and mortar retailer without them, having the Square checkout, and it's a really, probably my favorite one to use when I'm checking out. As seamless as it gets. You pop out your phone and or your card, and you just tap and go. And I've only seen more and more, so it's trading like it's supposed to go to zero. And with growth like that, and just a good business model, it seems like a pretty good opportunity.
Yeah, and you can see on the sales growth, 2023 expected to be up 22%, and then 2024, 12%. So obviously these numbers will change and adjust as we go along. But even on, in a recessionary environment, and if this slows, it's still pretty attractive given the huge sell-off here. Yeah. But this kind of goes to what is always the scenario, is that, a stock is hot and everybody wants to be in it. And then when it's not, everybody does, they jump ship, they get out of there, and then it can go where it is truly a value, and where, you and I are sitting there going, what's wrong here? What are we missing? So that's when the value investors really sit up and take notice. So for some reason, this podcast has kind of evolved into maybe a little more of a value bent than I would have thought. Do you think that that's like just because of this correction we're in, or is that the tone of the market right here?
Well, I forget who said it. I don't know, some famous investor, but all good investing is value investing, right? You want to buy
Right.
something for less than it's worth. It's a good way to limit your risk and, get good returns.
Yeah. Okay, well, this was a lot to cover on this episode, but I feel like with the stocks really weak here, it's a good time to consider your strategy and think about having a watch list of some kind. Maybe it includes some of these, maybe get a little more defensive here if you're staying in stocks while all this is going on. And to remember that November and December usually are the best months for stocks of the year. We'll see if that pans out this year. There's no guarantees, but you might want to have a plan in place if it does happen. So let me recap the stock tickers we talked about. There was Vistra, which is the utilities, and its ticker V as in Victor, S as in Sam, T as in Tom. We did talk about Alphabet. Everybody knows that one, but it is GOOGL. And then there was energy with the big oil, Chevron, ticker C as in Charles, V as in Victor, X. And then we mentioned Warren Buffett and Berkshire Hathaway, ticker BRK. And then on Zacks.com, it's period B to get the B shares, and it's period A to get the A shares. Some sites use a dash there as well, but on Zacks, it is a period. So BRK period B to get the ticker. And then Block is still ticker SQ from its Square days. Apparently, it has not secured the Block ticker yet, and maybe never will. So it'll remain SQ. And as always, you can get all of our podcasts on Apple. You can get them on Spotify. You can get us on Amazon Music. You can also get this as the video podcast on Zacks.com/YouTube. And you can get it as just a normal podcast that you can listen to on our podcast page on YouTube, which is just Zacks Podcast. You can subscribe separately over there and get all of our podcasts, including, ETF Investor and all of our other great podcasts on there. So be sure to get us somewhere, and I'll see you again next week with some more stocks.